Hi, everyone. My name is Hassan. Thank you so much for joining us on yet another webinar. We'll just wait a few more minutes. I think we'll wait another 5 or 10 minutes, allow some more people to enter this meeting, and then we'll begin. I believe Siddiq has joined us as well. So Siddiq from SmartCrowd, who's of course the CEO and founder. There he is. Perfect. Awesome. So Siddiq, we'll just give another couple of minutes before we start the webinar.
Sure. Can you guys hear me okay?
Yep. Sounds good.
Perfect. Ramadan Kareem to everyone that's here.
Ramadan Kareem to you too as well, Siddiq. Sorry, I feel like everyone else is on mute, so probably deserve a response to that.
Nawaz, we're not trying to punish you. It's just sometimes people have connection issues. It's just courtesy more than anything. To give it a few minutes, we'll get started. Only the right answers get prize.
Who decides what the right answer is?
Question. You asked a difficult question. You don't get a prize, Amar. I'm sure Hassan will answer that and tell people what we're talking about.
Yeah, I think it's a good time to get started. I think everyone is here, and just in the interest of everyone who has joined us on time, I think some people will, of course, keep joining us. So welcome, everyone, once again. My name is Hassan. I'm part of the marketing and business development team at SmartCrowd. And of course, I'm joined here today with Siddiq, who is the co-founder and CEO of SmartCrowd, and Amar Malhi, who is the head of client relations, who will be manning the chat this afternoon. So if you have any questions, of course, please feel free to write them in the chat, and we'll make sure that we get to questions at the end. Or if it's relevant, then Amar will definitely make sure to interrupt or nudge me and ensure that I ask your questions in a timely manner. Everyone is reminded that this webinar is purely for informational purposes. It's educational. We're here to provide you some value in the form of some content. Of course, this is not to be misconstrued for investment advice. Any sort of investment decision or any investment that you make, please consult with a financial advisor or do your own due diligence. So I feel like I needed to get that out of the way from a compliance perspective, of course. I think we've got a lot of great information today. It's jam-packed. We're going to try and keep it to the hour. So we'll get the presentation from now up until around 5:40, 5:45, and we'll leave about 15 minutes for Q&A. And in terms of the prize, that's a very good question. Let me just cover that here in the beginning. Amar has shared a link. It's a Typeform link. You can click on it, and all you need to do is input your email address to ensure that you have signed up and attended this webinar. All people who have attended the webinar are going to get a gift certificate that they can effectively use on SmartCrowd towards any investment, or you could even share it with a friend. So the choice is really yours. Today we'll be discussing, a big topic. It's on the minds of a lot of people. The property market has been picking up. A lot of people have been thinking about, of course, buying properties. And one of the first things that pops into people's mind is, I'm going to put on a down payment and then mortgage the rest. So, I don't think the answers are going to be as clear cut as most of you might have suspected. But without further ado, I'll leave it to Siddiq to introduce the topic and himself and just dig into it.
Well, thank you very much, Hassan, for the intro. I'll try my best to keep it to the hour. Do drop the questions and we'll get to them as we go along. Anything specific during my conversation, Amar will stop me and we can address those. So, as Hassan mentioned, it's a very relevant topic. A lot of people are looking to, there's excitement again in the real estate market here locally, all over the world actually. And it's a very common question people ask, should I mortgage or not mortgage my investment property? Because real estate typically requires a lot of capital and many of us don't have that capital. But for many, the option is only to get finance to get on the property ladder. So it's a very relevant question and we will do our best to address that and sort of lay out a picture of both the pros and the cons of going down that route. You guys can see my screen, right? Yeah. Cool. I'll skip on the disclaimer, as I already talked about it. Just to give a little bit more background about myself. I'm Siddiq Farid, I'm the founder of SmartCrowd. I'm a chartered accountant and a CFA charter holder. Over 30 years of corporate finance experience, mainly in Big Four accounting firms in 3 different countries. I am what you would call a pure numbers geek. So what you will hear for the next hour and so forth is purely a lot based on logic and calculations. I think what's important is I wanted to share my story as to how I got excited and interested in the real estate space that eventually led me to find SmartCrowd. And I think there's a lot of learnings from my experience that'll come out of it that we'll be able to relate later in the topics that we have in this webinar. So I won't dwell too much into this. Hassan, Amar, please time me on this and feel free to cut me off if I sort of go on too many tangents in my story, because university time was a really good time for me, and I might end up talking about some stories that are totally irrelevant over here. But my real estate journey started when I was in a university. In the first year, I lived on campus, and university for me was back in Canada. That's where I'm from, in Ottawa. So after the first year I was on campus, I moved out of campus, off campus, and I was living in an apartment that I was renting by myself. And at that time I realized there's this saying, a lot of people say here, renting is waste of money, and when you can buy a property. So at that time, I was able to convince my parents to give me a little bit of money that I could use as a down payment to get myself an apartment that I could pay a mortgage for instead of paying rent. And the shrewd student of finance that I was, I convinced my parents to give me a little bit more extra money so I can get a 2-bedroom apartment, and then also convinced them to get me a parking space as well too. And then I said, might as well go for a 2-bedroom plus den, because I can rent all these extra rooms out. I can rent out my parking space and make this extra cash to cover all my expenses, not only for the mortgage, but also for my schooling and so forth. And God bless my mother. She said, okay, fine, take it. Probably should ask her now how she feels about that, but that's a different story. But that's how I started sort of in the real estate journey. And then, the timing was really good for at that time. This was 2000 and I'm going to age myself over here, but 2003, 2004 time period where if you look at the real estate prices in North America, particularly in Canada, from that point onwards, they've been sort of in a rapid to the right. We can't get the right angle in looking at the camera, but right to the top kind of a trajectory in terms of price increases. So the timing worked out really well from that perspective. And what that led me to do is it allowed me to refinance my property, that condominium that I had, and take out equity, because the prices have gone up of the condo. I was able to borrow more money against that property, take out some cash. And what I did with that cash is I bought a second property. I bought a property right next to the university campus, actually a semi-detached home, a very rare opportunity in that neighborhood, where I had 6 bedrooms in the house, converted into a 6-bedroom with 3 full bathrooms, which is very rare to find in downtown Ottawa area. Most of the homes around there are built in the 1800s, 1900s. You're lucky to find a livable basement and more than 1 bathroom in the house, where I had a livable basement and 3 bathrooms. So from an investment perspective, it was great because I rented out to students, and that generated really good cash flow to cover the mortgage for my house, cover the mortgage for my condo. And then I also had money left over that paid for my school. And I didn't have to work part-time. I had a really decent lifestyle, and that's why I enjoyed university a little too much, and I have a lot of fond memories. However, it did lead me to a lot of stress and headache along the time, because the challenge with that is, it sounds all great. It was allowed me to build some assets, some wealth, but it came with its stress and headaches, in the sense that my condo fees, which over here you would call service charges, also kept going up, and that always took a big dent on my cash flows. And I had a fixed mortgage rate. And these are all relevant because we'll talk about that more in terms of how these variables make an impact on your cash flows. At that time, the rates were coming down, and I was stuck in a very high fixed mortgage rate where I actually ended up paying. I decided to pay a big penalty to break my mortgage and refinance it at a variable rate, which was lower. And that worked out really well for me because from that point on, the variable rates kept going down. So I benefited tremendously, and that hefty fee that I paid to break my mortgage sort of paid for itself over the time period because I saved a lot of money on interest rates. But if the interest rate had gone a different direction, it would have been a different story. But it got to a point where the cash flows, my condo, the 2 rooms I was renting, they were no longer being rented. And then it became sort of a burden in terms of maintaining the property with the cash flows and so forth. So initially I got rid of 1 condo, I kept the house for another couple of years. And then eventually when I left Canada, I moved to the region.
Sorry to interrupt your story, Siddiq. Just on that note though, I mean, I think that's a very good point that you raised. You said, I couldn't meet the obligations. I know you're talking about your story in this case, but normally what would happen is someone would then need to pay that out of pocket themselves. Isn't that the case?
Correct. Yeah. So keep in mind, I was a university student, so I didn't have any other income. The only income that I had was rental income coming from these 2 properties. And if I didn't have that, forget making the mortgage payments and so forth, I wouldn't have money to pay for my university and for food and so forth, because these 2 properties were financing my entire life at that time, right? Paying for my university, etc. I did have some student borrowing as well too, to pay for some, because there wasn't that much cash that was coming out of this, because obviously you have debt obligations, but there was some cash that was helping pay for some of that stuff as well too. So managing the cash flow, we'll talk a lot about that later on in the webinar. So that's a key component when you're looking at these opportunities. Is cash is key. That's the underlying determinant as to how you make your decisions, not from emotions and so forth, or superficial stuff like, hey, I'm a student, I have 2 properties. I wasn't wealthy. I was indebted. Technically, I had 0 assets. I had 2 big liabilities of two very big assets. And then when I left the country, it was very difficult for me to manage. When I was there, I was treating it as my house, etc. I had very little turnover of students, but when I left it to third-party manager and so forth, it became a little bit difficult. And I finally exited both the second property as well too. But there's a lot of learnings, and since then I've not invested. I've invested in real estate, but I've not invested in real estate using mortgage from that point onwards. And there's various reasons for that, and we'll dwell into that. But I think that provides a little bit context in terms of I've been there, done that, a lot of learnings from it very early on in my life that has led me to my understanding and my conviction on certain things when it comes to financing real estate. So there's a couple of my GIFs are not working in this Canva. I was testing it earlier. I was hoping it would work when I went live, but it's not. But there's a couple of myths that I want to bust, right? In the sense that this whole notion of, owning a home, especially owning a home on financing, it's an investment, it's an asset, renting is waste of money. All these are inaccurate statements, right? I strongly believe those, right? There are certain people that are incentivized for these sayings to be quite the norm because they benefit from it. It's mostly the financial institutions, the brokerage community, and so forth that sort of instill into people that this is how you sort of create wealth by mortgaging and buying your home as your investment, and rent is waste of money and so forth because they directly benefit from it. It's anything but that, right? So you have to look at it purely as to what defines an asset, right? Why is rent not waste of money? Because people don't factor in the opportunity cost of the money that you're putting down payment and the delta between the rent, the difference between your rent and your mortgage payments and how you manage your cash flows. That are the determining factors as to what is the right choice. But going more specific in terms of why financing a home that you live in is not an investment, is because it's not really an asset. It's creating a liability. You don't own an asset. Rather, physically you own the asset, but you own a massive liability to a bank against that asset, and there's no positive cash flow. You're actually paying someone, the bank, to live in your own home. So it's not really an asset. An asset is something that generates you cash flow and positive returns in your pocket. And by taking on that big debt onto a big obligation, it really restricts your flexibility and optionality, right? As opposed to renting a property, for example. And what happens is you become too dependent on market outcomes, such as what's going to happen to the interest rate, what's going to happen to the house prices and so forth, because you have a significant amount of your capital tied up into that, and that creates a lot of stress and so forth. And this can also be relevant for you financing your investment property, but financing an investment property is slightly different because you do have some cash flow coming from it. If you're buying the right property in the right place and the cash flows make sense, then yes, that can be constituted as an investment. Like in my case, it was an investment because I wasn't paying to live in those properties. In fact, I wasn't living in one, but I was using it as a rental property as well too, by renting it out and generating cash flow that was covering my expenses and so forth. So that was, and at the same time, I was building an equity. I was using someone else, paying the rent, paying the mortgage down, etc., and so forth. So from a cash flow perspective, that made sense at that particular time. But there's a lot of variables in there that went in my favor, that worked out really well, that if they gone a different way, it might not have been so pretty. So given the time frame that we are in, a lot of people are considering it. A lot of my friends are considering it as well too. This is a common question I get asked a lot. So, when is a good time where financing makes sense? Because there's a lot of good elements of financing. I'm not totally anti-financing. There's elements of it, how you want to structure it, because if you don't do it properly, you can get yourself in a lot of trouble. Financing makes a lot of sense when rates are extremely low, because your cost of borrowing is relatively cheap. The money that you pay to the bank to borrow money from them, if that rate is low, it becomes very attractive, especially if you can invest that money into an asset that's providing you a much higher return. So the rate of return that you're getting is higher than the rate of cost of borrowing. That difference, if that margin is big, then it becomes very interesting for you to borrow money and invest that money, but understand the risk associated with that. That's a good time to borrow. And historically, if you look at it over the last 10 years, we've gone through a period where historically low interest rates. So the period of borrowing money and investing, we've had that opportunity over the last decade. Would that continue in the future? The jury is out there. The rates have been rising rapidly over the last year or so, and the predictions are they will continue to rise. So, in that environment, what you have to factor in is the rates start going up, your obligations to the bank will increase, and if your rent or your returns are not keeping up pace with that, you're going to end up paying money from your pocket. So you need to factor that in. The other time to finance is, if the prices are expected to increase and expected to grow as well too, because then if the prices are getting inflated, your debt is fixed at a lower price when you bought the property and the property prices are higher, you can sell it at a higher price and make that difference. So that becomes a very attractive time where you want to consider maybe financing the property. And obviously you want to look at your cash flow. Does the cash flow from renting this property, does it cover my mortgages? Does it cover my service charges? Does it cover all my other expenses? And does it help me create a small reserve in case the property goes empty, etc., and so forth? Because you want to be able to hold on to that investment. Because when it comes to real estate, the longer you hold the asset, the more return you make, because it pays down debt over a period of time. It provides you cash flow from renting and so forth. So you want to hold on to the market. It's more important the time you spend holding that investment in the market rather than timing the market as to whether you buy the property at the absolute bottom low for you to make a return. Holding power is a lot more critical than timing the market. So time in the market is more important than timing the market. I hope that makes sense. We can talk about that a little bit later as to what I mean by that. There's a few questions on that. But that cash flow is completely important because that allows you to have the holding power where you can sustain your investment. So that is very critical. If you can stress test that and that works, then financing makes sense. And then obviously, you finance because you don't have enough capital to buy a property. Many of us are in that case, but this is the reason we founded SmartCrowd. We can talk about that a little bit later as to how we sort of mitigate a lot of these risks that are associated with financing a property. So pros of financing a property, right? You get more bang for your buck. Like I said, I was a university student with very little cash. My parents gave me some money to put a down payment. I was able to use that and leverage it and create, an asset pool that was much larger than that money. You're essentially having someone else pay your debt by renting it out. Someone who's renting is paying down your debt, and you're building equity. So it works really well from that perspective, because it's all like automatic savings plan, as long as you're not putting more money into it and everything's being covered by the income that is coming from it. And it can also create even additional cash flow for you if your cash flow is higher than the money coming in is higher than the costs associated with that investment. And it can provide really healthy returns if you time the market, in the sense that if things go in your favor in terms of rents, interest rates are going down, property prices are going up, rental are going up, it can generate really, really healthy returns. But just as they can generate healthy returns in a down market, it can literally kill you from a financial return perspective. And that's where the cons of mortgage come in, right? Because one, you're creating a liability for yourself. You're increasing the risk of the investment. Investing in real estate has its own risk associated with that, such as real estate, what's happening to the real estate prices, the rental market prices, and so forth. When you introduce debt into it, you're increasing your risk associated with that investment, because now all of a sudden you have exposure to interest rate risks. And so forth. And then you need to increase and you need to substantiate that by generating better returns than if you were to have bought that property on cash. It also reduces your holding power that can lead to massive losses if you're unable to hold on to that, right? So I'll give you examples in recent times where, during the downturn, especially in COVID, where people lost their jobs, etc., and they didn't have sufficient capital to, they might have lost their tenant, or whether they were living in their house and they were able to meet their debt obligations and so forth. The house potentially got repossessed by the banks and so forth, and you end up desperately selling the house at the worst possible time. And incur massive losses, right? Because the amount you owe to the bank might have been more than the actual value of the house at that point in time. Not necessarily during COVID, but that could happen at any point in time. That happened a lot in the financial crisis back in 2008, where people had borrowed money to buy a house at $1 million dirhams, and the property price was 600,000 dirhams, but they still owed the bank $1 million dirhams, right? So you don't want to be in that situation. That can, so as financing can enhance your returns, it can also lead to large losses on the way down. And most importantly, it really restricts your optionality. It reduces your flexibility because of that debt burden that you have. You have an obligation, and having that level of burden, it really reduces your options in terms of what you can do, especially if you're living in that and you happen to get a different job, or you have to move to a different country and so forth. It's not really easy for you to just pack up and leave, whereas compared to renting it and so forth. So there's different things to look at. My conversation here is mostly thinking purely from an investment perspective, but I do mention about renting and so forth. We'll talk about that a little bit later if we have time. We can walk you through an example in terms of rent versus buying. But if you are considering that option, a lot of people, or a lot of services online, when you Google these things, etc., they clearly show, hey, your rent is lower than your mortgage, or your mortgage is lower than your rent. You should definitely finance it because you'll save more money, etc. Well, that's
So, sorry to cut you off just before you get into a new segment here.
Yeah.
One of the questions was, how long was your mortgage? Because the Canadian market's obviously different. So I think people are trying to compare to the market here as well.
Yeah, so in Canada, so typically when you do a fixed mortgage in Canada, it's a 5-year mortgage. In the US, you have 10, 20, 30 years. And in fact, they're actually proposing a 40-year mortgage, allowing people to refinance, all the people that have not been able to make payments during COVID and so forth. So imagine, 40 years of your life you're going to spend paying back, right? But in Canada, it's 5 years, and you refinance every 5 years. So even if you have a fixed rate, that fixed rate is only good for 5 years. And after 5 years, you have to get a new mortgage. And in that situation, the rates could be much higher, could be much lower. So that's the risk that you have to take when you are financing. And variable rates are open-ended, but then obviously you run the risk of a variable interest rate, that in the sense that if the interest rates start going up, your interest that you owe on that debt starts increasing as well too. Here in UAE, typically you will have 1 to 2 year fixed IBOR rate, and then it becomes a floating rate up to a certain point in time, I think 5 years or so, and then you can refinance at that point in time and so forth. So you got to be very careful in terms of how the interest rates are. Don't look at it just from what it is currently. You got to look at it 2-3 years out and really stress test that in terms of how that will impact your payments, because today the payments might look attractive, they might not look so attractive in year 2, year 3 time frame. Does that make sense, Amar? Yeah. Okay.
Yep, makes sense.
Yeah. So just along those lines, right? That's a very just looking at comparing mortgage payments to rent is a very misleading indicator, right? That's not the only thing you want to look at when you're comparing your alternative. And I'll talk about a little bit later some sort of quick hacks, quick tips that you can do, sort of back of the envelope exercises to give a sense as to whether this is even worth considering or not. But the obvious ones are service charges. You gotta pay that, right? You have maintenance on the property, and if you are investing this property as an investment and so forth, then you gotta factor in the property management, and you also have insurance. So all those things add up, right? And in most cases, especially in the current environment, in Dubai, for example, the rents are pretty low. Right, and I'm pretty sure that whatever property you buy today, your mortgage payments will be higher than your rent, right? So so it becomes very tricky to does that really make sense, right? Like, why would I be paying more to buy a house to live in it, where I can rent it for cheaper, and the money that I'm saving, I can invest that money, for example, and I can probably make a return on that. So you got to be careful in terms of what you're buying and so forth. Obviously, there's no cookie cutter answer over here, because it depends on the property that you're getting in, etc. And we will walk you through an example right now in terms of how the numbers play out, right? Because it all comes down to quantifying it, right? You really have to, when you're making these kind of decisions, you want to keep emotions out of it, right? Because we've been programmed to believe that renting is waste of money. Buying a home, whether it's mortgaged or not, buying a home on mortgage is an asset, etc. So put those conceptions, those ideas away, emotions out, and just focus on purely the merit of the opportunity and whether that makes sense financially. So I'm going to try to where is this? Maybe 1 second here. Can you see my Excel file?
Yep.
Awesome. So here, let's make it a little bit interactive, right? Does anyone have a property in mind that they're considering of purchasing the investment? If so, just throw it in the chat. We'll try to use that as an example of what that looks like potentially. Anyone? Any ideas?
Don't be shy. I know it's Ramadan. I know a lot of people are probably fasting as well. Yeah, this is.
I was looking at MR South.
Okay, MR South.
MR South. 2 bedroom, 3 bedroom? Townhome?
2 bedroom.
2 bedroom. Okay, so hold on 1 second here. I'm going to, you guys can see this as well too, right?
Yep.
All right, so there's various options obviously over here. Let's just let me click on one of these. We'll just take averages for our purposes, right?
Yes.
There's no price trends over here. It's very difficult for us to do that. But let's say, okay, average property size is 1,300 square feet, and let's assume 700 as an average price, right? There's lots of listings. This is one of the lower listings, but let's go with that, right? So what do we say? 1,300 square foot, 700. That is approximately 538 per square foot. All right, let's just make it 550 for our purposes and keep this round numbers, right? So that's your property purchase, right? And then you obviously have to make a down payment of 25%. Let's assume you have a flat rate of, have you considered financing this, Prakash?
Yes, around 4%. Yes. Yeah. Yeah.
Is that what the bank proposed to you? 4%?
Yes. Yes. Around
Okay.
3.4%. Yes.
Okay. Okay. So let's assume 4% for now. There's a valuation fee that you have to pay. You have to pay the bank fees. There's an early settlement fee if you end up paying your mortgage earlier and so forth. So all those are costs associated with that, right? So you need to have cash for all these extra charges, the land department fees, the trustee fees, etc. So it's not, the total cost is not 715. It will end up being 800,000 or so. So what you will need is 200,000 dirhams cash today to be able to purchase this property, right? If this is your first property. If this is your second property, you will need to put even a higher deposit down to be able to finance this. Now let's look at what the current rent for Emaar South is for 2 bedrooms, just to get a sense. I'm assuming we're looking this from a purely rental perspective, investment property perspective. So as you can see over here, you have various listings all the way from 26,000 to 40,000 or so, and it depends, right, whether this is a ground floor one or the first floor one, because on the ground floor you get a backyard, on the first floor you don't get a backyard but you get a patio and so forth. But let's say, given there are lots of lower listings and so forth, let's assume 35,000 is the current market rent, right? Prakash, do you know what the service charges for this one are? I think like 6 or 7 dirhams per square foot. Do you recall? I think they're like, for these townhomes.
6, I think. 7.
6,
Yeah.
okay. Yeah, I remember being 8, but that's fine. 6. You'll probably have someone manage this property, so you'll pay them 5%. Property insurance will be around 500. Annual maintenance, let's assume 500, and let's assume occupancy of 80%, right? You can probably increase that to 90% if you want. That is how often is the property vacant, between turnover between tenants and so forth, etc. And let's assume we're in an environment where prices are increasing, that the prices will increase 2% every year, and you are going to hold this property, Prakash, for 10 years, right? Based on this scenario, this is a real life scenario, right? So if you finance this property, Prakash, today, you obviously need to put in 200,000 dirhams of cash, right? Your gross yield on this property, your rent is only 35,000. You're paying 700,000 dirhams plus on this property. Your gross yield is 4.78%. Your net yield is negative, right? Because it's not going to cover your mortgage payments. Your mortgage payments are higher than what the rent is on this property, for example, right? So you can see the scenario over here. It's your returns are negative. You end up making a lot of return at the end, but look where the return is coming from. The return is purely coming from property price appreciating in the future. If the property price doesn't appreciate in the future, you actually ended up putting money out of your pocket to have this property, and if it doesn't appreciate in value, you will make no money on this property, right? And now compare that if you had bought this property on cash, right? Even though your gross yield is low, but you're getting positive cash flow coming in because you don't have that obligation, and you will end up making money on this property And it's very balanced in the sense that, yes, you will make money on capital gains because the property prices have gone up, but you also made income for the 10 years, right? And keep in mind, this money is coming at the end of 10 years, right? Whereas this money is coming throughout the 10 years. So money in your pocket today is worth a lot more money in 10 years, right? Does that make sense, Prakash? Right? Just looking at it from that perspective, I'm happy to look at a different example if someone has a
Siddiq,
different purpose.
I think on that note, I think it's important as well to mention why money upfront is worth more. It's because you can reinvest it, you can
Correct.
compound it, right? And so you can make it work for you today. And again, as we know, money is worth more today when you factor in things like inflation as well in the future. If you're looking 10 years down the line, inflation in, you know, most economies is anywhere between 1.5% to 2%. So that's then again eating away at your returns.
Yeah, absolutely. It's just no different, right? Think about it, right? Like $1,000 back in 1900 was a lot more than $1,000 today, right? $1,000 back then would get you a lot more than $1,000 would get you today. So, you know, the present value of anything today is worth a lot more than it would be in the future. I don't want to get too technical there, but I hope that makes sense, right? So, you know.
Hi, Siddiq.
Yes.
Just a quick one. So some banks now, they accept 20% down payment as well. So I'm just wondering, would that change the equation if the down payment is brought down?
Sure, yeah, we can. So the beauty of this is you want to stress test this, right? Because you want to see, okay, fine. Okay, if I do 164, that's fine. My total return will be better because my capital gains will be higher, right? But my cash flow doesn't change because my cash flow doesn't change because of the interest rate. The interest rate, if the interest rate were 2.5%, does that make a difference? No. In this situation, what will make a difference is the rent, right? The rent will have to be substantially higher for you to get to a point where it becomes economical for you, right? Okay, you know what the problem is? I'm using current annual rent. There we go. Right. So as the rent increases over time, then the equation will become better, right? So whereas if you were comparing this to buying this to live in, right? For example, why would you buy this property to live in where you actually can rent for a lot cheaper, and the difference you can invest and make money and subsidize your rent? So it's not necessarily rent being wasted. It's actually you being more sensible with your cash flow, and you're actually generating more income, and you're investing and you're building an asset as opposed to paying down a liability for the next 10, 15, 20 years and so forth, right? So the merit stands for both, whether you're looking from an investment perspective or you're looking to buy instead of renting. But this is probably a very extreme example because the rents are extremely low in Emaar South. Mind you, as a side note, I think from a long-term perspective, Emaar South is a really good opportunity because of the airport there in the future, the expo site, the whole push around industrial, the urban plan, not the urban plan, I forget the name of the plan, the 300 billion plan where they're trying to increase the GDP of industry contribution to GDP to 300 billion, almost tripling it from what it is in the next 10 years. All that has a massive opportunity in that part of the city where I think there's a lot of opportunities there. Obviously, you got to find the right asset that where you can maximize the rent and so forth, so your cash flows make sense. But from a capital perspective, you know, that's a pretty good. I don't want this exercise to make Emaar South look bad. That's not the intention of this exercise. I just want to make that very, very, very clear.
Siddiq, we have another question here in line with this. Nawaz is asking, you know, he says he's got a scenario, he's got some properties whereby every couple of years he has enough cash to comfortably buy a studio of up to 400,000 dirhams. So his question is, you know, would it make more sense to buy every 2 years, like a property in that case, you know, purely on cash, like a studio, or does it make sense to go for a mortgage and buy a higher value property? And then says that which will subsequently, I guess, pay him rental income. Now, of course, one caveat, one thing I do have to mention again for those people who join later, anything that we mentioned here is purely educational. This is not investment advice. This is just, you know, we're just going through different scenarios and we can offer what the outcomes might look like. So Sid, take it over.
Sure. Yeah. So Noah, it's a very good question, right? So there's a couple of things you want to ask yourself before we can answer that, right? What is your intention? Are you doing this to build a portfolio of assets that will grow in value and pay you in your retirement, or you're looking to generate cash flow today? If you're looking to generate your cash flow today, that sort of answers your question in terms of what your focus should be. But alhamdulillah, it demonstrates that you have good disposable income that allows you to save enough money to buy a studio apartment. So you are one of those few people that can take a little bit of risk because you have that ability to take that risk. So then you got to look at your goals. What is your goals, and whether taking that element of risk of financing the property meets within those goals, right? For my personal preferences, the less debt obligations you have, the better, because then you have a lot of flexibility. Then if you have the ability to amass enough money to buy a property every 2 years, even 3 years, that's phenomenal, right? I would continue on that path, right? Because if you start financing, then you do it in a way where you're not taking full financing, right? I would put down 50% down payment. So you have a lot more flexibility and control on your investments. So you're not putting yourself out at too much risk, and you still have sufficient disposable income to manage that risk if things don't go too well. Because a 50% down payment, even if you go through a rough period for a couple of years, you'll be able to manage that, assuming your primary source of income doesn't get impacted and so forth. But start off with understanding what your goal is, right? Are you saving are you investing in these to generate cash flow today, or are you investing in these things to accumulate these assets that will either grow in value in the future that you can sell and pay for your retirement, or generate income at that point in time from these to pay for your retirement? So that will dictate as to how you do that. And if you want to have a more detailed discussion, I'm happy to take it offline and we can walk through it in a little bit more detail.
Thank you for that, Siddiq. You mentioned, look, either choosing the option where you can generate cash flow today, or obviously save up and build up your equity and max out at a later point in time. I know the sweet spot is effectively in the middle, where you can get a little bit of cash flow today and you're still building equity as well. But how hard is that to do, particularly if we look at Dubai as a market right now with the current environment, the current situation? How hard is it to build your passive income from a cash flow perspective and equity at the same time, where your net ROI from a cash flow perspective is positive and you are mortgaging a property? How hard is that?
So in the current environment, it's quite challenging, right? Just because where the rents are, right? Because we just witnessed from this example, right? We can take any other example in a different area if someone has, we can look into it, and it'll probably be a similar case because the rents are very low at the moment, right? So, but that doesn't necessarily mean that those are bad investments. It's just that from a financing perspective, you got to be very careful in terms of how you're managing that cash flow element, right? So if you have the ability to pay down more debt, maybe more down payment, you can reduce your payments, and then when rent increase in the future, etc., you can refinance it and sort of rejig that element of it, because there's opportunity, right? Rent prices going up is a good thing, right? Your yield compression is a good thing. It's a sign of a maturing market, because if you look at more mature markets in the West, you don't generate the kind of yields you generate in Dubai, because a lot of the returns in real estate over there comes from a capital appreciation perspective, right? So having a lower yield is not necessarily a bad thing, right? It's actually, in fact, a very positive momentum for the market, because then you will have more capital appreciation than income play, but you also want to generate some income as well. So you need to find that right balance. And there's no right or wrong answer there. You just need to look at different scenarios, look at the kind of different properties. But one thing is very important to understand, that wealth doesn't get created overnight, right? It takes time. It takes patience, right? If you're looking to get rich overnight, there's Bitcoin for that. But you don't want to go put all your money there.
This is not
right?
advice. This is not advice.
No, but the point is, if you have investments like this, like a real estate, etc., you have some stable investments, and then if you have the ability to take on a little bit of risk, you can allocate some money into those high risk investments that can pay you a good payout. But you wouldn't put all your money in those situations, because you can end up losing a lot of that money, right? So it's understanding that wealth takes time. Warren Buffett, he generated, I think, 80% of his wealth after the age of 50, right? So you have to be patient when it comes to these kind of things, right? Especially when it comes to real estate investing. building income is good, and it's how you use that income, right? Even if you're generating small amount of income, you need to be very disciplined with that income that's coming in, whether how small it is, that you're reinvesting and compounding it, right? Because if you don't require that little income, you're probably going to end up spending it and so forth. Reinvest it, it will compound, and after 5-10 years, that would have grown into something, because that would have, you invest, it pays you back, you reinvest that, and it grows. Compounding is a phenomenon, right? Einstein called it the eighth wonder of the world, and that doesn't necessarily mean interest compounding, right? It could be just return compounding. If you buy a property, for example, in Nawaz's case, he's buying a property every 2 years, he's getting income coming from it. He's using that income, using his primary source of income, putting that money together and buying another property, right? And if he keeps doing that at this pace, I don't know how old Nawaz is, let's assume he's a young fella at 30, and he's going to do that for the next 10 years, he's going to have, or next 20 years, he's going to have 15, 20 properties, right? And then I can assure you, regardless what the rents are at that time, I don't think he needs to work, right? He will have enough money coming from those properties that's paying him, but he worked 20 years for that, and now he can relax, right? Or even retire earlier, depending on the situation and so forth. So having that discipline of being patient, investing and reinvesting, and that's why cash flow is so important, right? You got to look at it from cash flow perspective. If you're going to buy things or invest in things on the hope that in 10 years, this house will be worth 800, 900,000, I'm going to make money, you're hoping. Hoping is not an investment strategy, right? What happens in 10 years when you're ready to retire, market crashes or something happens, and it takes another 5-6 years for the market prices to recover. You don't want to be in that situation, because you would have had this 10 years not have opportunity to earn cash.
We've got a question here. It's on the model that you're showing everyone. It says, the question is from Hamda, and they're saying, why is the mortgage length and holding period not the same number? So you've got 10 there as a holding period.
Good question.
And then the mortgage,
Good question. Yeah, so that's just an input, right? So because you might, as an investment property, you might decide to sell after 10 years. You can hold it for 20 years as well too, right? That's not a problem. The model is built for you to play around with the numbers. Because if you hold it for 20 years, then obviously your capital gains will be great, because your property price has increased even more, because the more time you hold, and if it keeps growing at 2% every year, your property value will be much higher, your capital gains would be higher. Whatever the rent scenario that would be, but again, it comes down to, in this scenario, it's still capital gains is the chunk of your returns, right? And if that capital appreciation never happens, imagine you get zero capital appreciation, right? The gain that you have is because you've paid down the mortgage, right? And you're just getting that money back. All that money that you have spent over the 20 years, that's the money you're getting back. So essentially, you could have just been saving in a bank account cash, and you'll get that money back. I hope that makes sense. That's probably not very clear, right? Because keep in mind over here, when you look at the exit price, you bought the property price, but your cash contribution was only 164,000, right? When you made the mortgage payment. So even after 20 years with zero capital appreciation, the price is 715. The difference of this is what you're getting back, right? Because you've paid off the debt. It's completely paid off after 20 years. So you're getting that money back. But that's not a good return on your capital if that was a scenario, right? I hope that makes sense on that. But these are variables. We'll share this model. I'm sure the guys will share this model. Well, all these cells that are highlighted in yellow, you can play around with. And over here, I've also have inflation as well too. Like what's the inflation of the rent? When my rent go up 1% every year or 5%, you can play around with this. As well too, and then it's going to change these variables, and you'll be able to see the outcome. All the calculations, etc., are over here if you want to get into the weeds. But if you have faith in my calculations, you can just rely on this dashboard. Otherwise, please do test me on this and send me comments if you see some mistakes. It would be helpful, but I'm fairly confident that the numbers here make sense.
Great. So just in the interest of time, once again, I'm just going to mention to everyone and say that if you have not, signed up or registered for this webinar, we have a link where you can register and effectively let us know that you did attend this webinar. I'm just going to paste it here again for everyone's reference. Make
Just
sure
before
that
you, sorry, Hassan, before you go into it, just to wrap up, some quick tips for you guys to make quick decisions, right? To figure out whether it's worthwhile to do further analysis on this, right? So one thing you want to look at is what is the cost of borrowing and what is the rental yield that you're getting in, right? So what I mean by that is, like, for example, in Prakash's case, he talked about the Mar South one, right? He said the cost of borrowing was 4%, right? And we looked at that. If you look at the rent minus the service charges, right, and divide that by the rent, the property price, that was well below 4%, right? You're borrowing money from the bank at 4%, but the return that you're generating on this is less than 4%. Hence, you had that negative cash flow, right? So that's an easy way of looking at it. If you're able to borrow money at 4% and invest in a property that is generating 7%, that would be better, right? So for example, if you went in an affordable area where you can generate a higher return, then the difference between the return that you're generating versus the cost that you're paying, there's a nice margin, a gap, then that becomes interesting for you to evaluate further to see your cash flows, right? But if you have that, or if that gap is very narrow, then it's too risky, because if the rates go up or the rents go down, it can really hurt you. So that's one easy way to look at it. The other way to look at it, if you're considering buying versus renting, is you want to look at the amount that you're saving between your mortgage and your rent payment. When I say mortgage, all-inclusive mortgage payment, your service charges, etc. If that is lower than your rent amount that you would pay to live in a similar property, if you're saving money, then that's great. Take that savings that you're taking. So for example, your rent is 100,000 dirhams and your mortgages are 80,000 dirhams, for example. So you're saving 20,000 dirhams, right? And you bought a 2 million dirham property for which you paid a down payment of 500,000 dirhams. Take that savings, divide that by the amount you put down as a down payment, because that's your investment in that house. 20 over 500,000, that return, whatever that return is, that would be 4% return, right? If you feel like that's the best return you can get in any other investment that you can make, then that makes sense. Otherwise, why would you put your 500,000 dirhams in a situation where you're generating 4% return, where you can put that 500,000 dirhams somewhere else that can give you 6%, 7%, or 8% return, or even 5% return, right? Because over a period of that long of a period, assuming you're going to hold that property for 10 years and 15 years, even that 1%, even 0.5% difference between 4% or 4.5% or 5% over a 15-year period makes a massive difference, especially if you compound that over a period of time. So that's another quick way of looking at it. Okay, if I'm saving money from mortgaging versus rent, and the savings over the amount that I'm putting down as a down payment, what does that equate as a return? Can I get a better return investing in some other real estate or some other investments? Then that doesn't make sense for you to do that. But if it's equal return, etc., then it might make sense.
So Siddiq, just for everyone's reference there, just to recap. So you mean whatever the cash outflow was, that's obviously the input, that's the investment that you've put in, an inflow per year, take cash inflow, divide that by cash outflow, which was effectively your down payment. And that's how you're going to get your annual return. Is that correct?
You lost me there.
Oh, I was just talking about, cash inflows and outflows, because I think you were talking about the spread, and I just want to make it easy for people to remember if they were to conceptualize this as a formula.
So for this particular one, this quick tip, right? So like I said, 100,000 dirham is your rent. If you bought a similar property, etc., your mortgage payment would be 80,000. So you have an instant saving of 20,000 dirhams, there, right? As opposed to renting. But for you to buy that property, you need to put 500,000 dirham cash. So effectively, you're making 20,000 dirham return on your 500,000 dirham investment. Yeah. So that's a 4% return, right? So that's a simple way of looking at it. If you feel like you can get a better return for 500,000 somewhere else, then that doesn't make sense for you to do that, right? To buy that property. You rather put that 500,000 dirhams, generate a 7% return, and use that returns to subsidize your rent that you're paying 100,000 dirhams, right? Because you're going to pay 80,000 anyways, right? So, but that's a very simple exercise, right? Because there's obviously element of equity building and so forth, but this is a very generic high level, because if that makes sense, then you can go and do further research or analysis based on that model and so forth, and really figure out your cash flows and stress test those cash flows to get to a more constructive response or decision, rather. Make sense?
Yes, no, it makes sense. Absolutely. Just, if you have some other closing remarks, and then we can get to some questions, and then I think
Sure.
we can wrap
No,
it up.
I think that's what I had. Wanted to keep it nice and short this time.
Okay, great, fantastic. So just on the hour, we have one question here from Rajiv. He says, in fact, before I get to Rajiv, I have seen your question. I know there was quite a few questions that came in. We have, one was, I did read it. I can't remember who wrote it, but someone said over the last 5 years, from a capital appreciation perspective, there really hasn't been any. How do you kind of base that for the Dubai property market? And I remember reading specifically, it was mentioned the 5-year period over the last 5 years for this market. So would you say 5 years is a good enough time period to assess the property market when you compare Dubai, even with, mature economies, or should we be looking at a longer time horizon?
It's a very good question, right? So it depends from market to market, right? So a more mature market have longer cycles. A maturing market like Dubai has shorter cycles, but the cycles are getting longer now, even in Dubai. That's a sign of maturing market, right? So if you look at the first couple of cycles from 2000 to the 2002 peak, and then from 2008, 10 or 9 crash to all the way down to the bottom in 2011, 2012, and peak of 2014. Those cycles were less than about 3 to 5 years. This last cycle that we've gone through is a little bit longer, since 2014 down to now 2021, and now you're sort of seeing that bottoming out and sort of uptrend. So you've just gone through a 7-year cycle. I think 5 years is a reasonable time frame, right? But when you make real estate investments, any investment that you make, you want to do it from a long-term perspective. You never want to do it. There will be opportunities for you to take short-term investment opportunities, and you can do that. Nothing wrong with that. But if you're looking to really plan your investments from a long-term perspective, whether it's real estate or even investing in stocks and so forth, you got to have a very long-term view, and that has to be aligned to your goals, right? What are your goals? Are you saving for a significant life event in 5 years, or in 10 years, or 15 years, your retirement, 20 years? And then your investments have to reflect that, right? The views have to reflect that. Otherwise, what are you going to do after 5 years? Okay, so you evaluate for 5 years, but your goal was for 15 years. What are you going to do after that, right? So have your goals, start there. We did a webinar on this a while back. That's why you should attend our webinar series, because everything is linked, and we talk about this, because the next webinar we're going to talk about not renting versus or more of financing. We're going to talk about payment plans in our next webinar as to whether that's a good option or not, as opposed to buying on cash or mortgaging, as opposed to payment plans.
Right.
And it's a very relevant one. But again, start with the goals, understand the goals, and that will dictate your time frame and how you look at the markets.
So when you have those goals in mind as well, let's say in this case, it was you had a goal that I'm going to sell in 10 years time, but I have my mortgage for 20 years. So we've got a question here from Hamda, and they've said that, when does it make sense to sell the property before you've paid off your entire mortgage? So in that case where you have a difference, right? And in which case would it make sense financially?
Yeah, so, there's no right or wrong answer there, right? So it all comes down to what are your return expectations and so forth. So obviously if the prices have gone up, et cetera, then that's a good situation, because that means you obviously have paid your debt down and the prices have gone up, so you're going to make profit. The situation you don't want to be in is when the prices have gone down and so much that you end up owing the bank more money than the property is worth. In that situation, you don't want to sell. You should be able to sustain that investment unless there's a big structural change and the market has completely changed, etc. And so a lot of my friends, during COVID and so forth, they had properties and they were considering leaving, etc. And they're like, should I sell? I'm like, listen, right? Unless you feel like this is going to be a long-term situation for you where you cannot sustain this, it's the worst possible time for you to exit, because you're exiting at a loss. And because you exit completely, there's no way for you to recover those losses, right? But that doesn't mean you continue to invest in bad investments as well too. But to answer Hamda's question, as long as you're making gains, it's always a good time to sell, right? You don't want to be chasing too many gains because that's why you get yourself into trouble. So that's why having your goals set is important. Once you achieve those goals, then you can reassess and exit. And when you exit your investment, you need to know what you're going to do with that investment, right? There has to be an avenue for you to. So the simple way to look at that is, if you get into 10 years and you decide, hey, I'm making X money, I'm going to sell this, that money's going to come in. What are you going to do with that money? You're probably going to invest into something else, right? Unless you met your goal and that was for some life event that you're going to use that money to pay for that. And that's a different story. But if that money is going to go to a different investment, then evaluate that different investment with your existing investment. Is your existing investment better than the new investment that you can put that money in? If it is, then sell it and put that money into that investment. If not, then you might as well continue holding on to your investment because that's a better option than whatever is available in the market. Does that make sense? I hope that makes sense. That's how I would look at it.
That's a very thorough question. So thank you for that, Siddiq. We have quite a few good questions coming in. We have one from MB. So he says, or I'm assuming it's a he, the mortgage LTV rules, so loan to value rules for second property are too conservative in the UAE. Are there any ways, or that you know of, for investors to maximize their borrowing beyond the 60% limit?
Listen, I was a university student with zero income and I was able to get a lot of money from the bank, right? So there's always tricks and traits out there, but I wouldn't recommend putting yourself in that scenario, regardless how good the situation is, right? Because things can turn a dime and can put you really in a lot of difficult situations. A lot of people that got themselves in trouble in financial crisis, especially in the US, is because, you know, they were over levered. And too much leverage is never a good thing. So if you're, and those rules are in place to protect you, right? Because you don't want to put yourself in a difficult situation. There's obviously a lot of ways, and you have your brokers and mortgage brokers will probably be able to give you better advice as to how you can maximize and take advantage of the system to get more leverage. But I would advise against that, and I would probably not get into those details in this webinar. Sorry.
So great.
Yeah.
No, that is good advice. That's sensible advice. We have a couple more questions and I'll get to them, but I realize a few people are dropping off because they probably do have other commitments. Once again, if you have not signed up to the link, we dropped it in the chat where you can effectively register and confirm that you attended this webinar. If you do so and you leave your email address, basically what we'll do is we'll send you a gift certificate, which will allow you to use it towards an investment on SmartCrowd, or if you even want to share it with friends and family, you can do that too. So only those people that register on that link that was shared will get those or that gift. If you don't, then you have been advised. But so we've got a question here, Siddiq, on SmartCrowd specifically. So finally, we've got a SmartCrowd question, and I know we haven't touched upon SmartCrowd in this session because, of course, our objective here is to educate and provide people value. But how do we deal with maintenance costs in SmartCrowd investments? I mean, is there any difference in terms of maintenance costs in SmartCrowd versus if you were just, purchasing a property on your own?
No, there's no difference. In fact, you don't have to worry about the headache, right? You won't get an email from your property manager saying, hey, the tub needs to be replaced. That comes to SmartCrowd. SmartCrowd takes care of it. But it's no different. All these properties on our platform are managed professionally. And if there's a cost associated with that, we take that cost from the rent that's coming from the property and cover that cost just like you would if you own the property yourself. No difference.
Awesome. We have a question from Khalifa. He says, what is the average payback period in Dubai right now? So if someone were to invest, how quickly would they be expected to recuperate their investment?
Yeah, so it varies from property to property in different areas, right? So the easiest way to look at it is you take the net return that you're making, divide by that net return will give you the number of years it will take you to recover that money, right? But there's that's a very simple way of looking at it because you're assuming the rents are going to stay flat, right? If the rents start increasing over the next 3, 4, 5 years, you can recover your money quicker, especially if you bought it at the bottom as opposed to.
And it only takes into effect just the cash inflow aspect, right? It doesn't take into consideration your capital gains.
Correct. Yeah, correct. So for example, if people that had bought Green's property in 2003 when they were launched, that money's been paid over multiple times over, and the prices have gone up, for example. Right? So it varies. Typically in Dubai, anywhere from 10 to 17 years, right? Assuming purely income, not capital appreciation.
Great. Thank you for that, Siddiq. So if anyone has any last minute questions, I think this is your final chance. Otherwise, okay, we have one final one, and I'll close it off after this. Do you think investments in Ajman are not very good? So it's a different city in the UAE, and Ajman isn't an area that we have listed on our platform, but I've noticed that almost all your investments are in Dubai. So this is SmartCrowd specific. So are we looking at Ajman? Are we looking at other geographies? What's the news in terms of SmartCrowd diversifying across or outside of Dubai?
So we'll be looking at other areas outside of Dubai in the near future. Right now, our focus is very much in UAE with a lot of opportunities over here in Dubai particularly. We will be doing international markets in the future. Perhaps by the end of this year, early next year, that's the target for us. In other Emirates, we have not looked into greater detail. We have considered Abu Dhabi and are evaluating opportunities in Abu Dhabi. For us, these are long-term investments. So we look for catalysts in terms of why it makes sense to invest in certain places. Dubai has a lot going for it. In fact, there'll be a blog or an article coming out very soon that I papered that titled "The World is Moving to Dubai," or my wife changed it to "Chalo Chalo Dubai Chalo," which is in Urdu language, meaning let's go, everyone, let's go to Dubai. Because it has a lot of things going for it. So we see a lot of opportunities in Dubai real estate, and gradually, naturally, that will have a knock-off effect on other Emirates as well too. But we have not looked into Ajman in quite a bit of detail because there hasn't been any rationale for us to look outside of Dubai. There's a lot of opportunities for us to consider within Dubai, so we're very much focused over here at this stage.
Great. So final couple questions in terms of SmartCrowd, so I can answer some of these and check them off. Is SmartCrowd limited to UAE residents only? No. Anyone from pretty much anywhere in the world, as long as you've got an internet connection, and of course, taking into consideration risk and compliance, can pretty much invest with SmartCrowd. We accept investments in 5 currencies. So you have dirhams, Saudi riyals, euros, British pounds, and of course, US dollars. So do you accept US passports for investments? Yes, you can. We do accept US citizens as long as it's below a minimum or maximum threshold, which is $50,000 a year. So as long as you're not investing more than that, we do accept US citizens, so you can invest on SmartCrowd. Secondary market estimate. When is a secondary market coming for SmartCrowd for the benefit of everyone else? We are looking to launch a secondary platform that's going to be live on the platform itself this summer. So please stay tuned. Hopefully within the next 90 days or so, we shall have that live. And we have another question, which is the net yield shown on SmartCrowd proposals. Does it deduct the 0.5% per annum of the SmartCrowd fees? Siddiq, do you want to take this, or I can take this? I'm fine either way.
Yeah, so we don't deduct our admin fee from the net yield. The net yield is what it is on the investment level. Our annual admin fee is deducted on an annual basis from your entire portfolio. So it's an amount, 0.5% of your total invested amount pro rata to the time period that you have invested on the platform. It's not a property specific expense. This is more of a platform service that we charge on your total investment that you have made.
And the important thing, as Siddiq was mentioning, in terms of time value money aspect of things, this is deducted once annually at the end of the year. So any dividends and rental income that you are running or earning throughout the year, rather, you of course have the opportunity to then reinvest that and effectively recuperate even that 0.5% by reinvesting your dividends. We've said how much is the difference in return between SmartCrowd and direct if I were to invest on my own in the market. Something we're really proud of in the market, or we're rather proud of in the team, is the fact that so far our property portfolio has been beating the market average. Now, of course, it is our goal and it is our aim to match the market. I don't think, and Siddiq, please feel free to chime in. I don't think, promising people that we're always going to beat the market is, of course, sustainable, because as we've seen over the last quarter, the market has moved. As Siddiq mentioned and alluded to earlier, rental yields have depressed because property prices have increased. But nonetheless, having said that, we do our best to put up good quality investment properties that make financial sense so that you can maximize your returns. Saleh, thank you so much. We will check Al Reef Apartments in Abu Dhabi. How is okay? So everyone, I think, just wants to get in their final questions now at this point. Once the final call was announced,
we'll give it 5 more minutes, and then I need to get ready for iftar.
Yeah, I think so.
The VAT just calculated the fees, and we clearly demonstrate that on the platform. So you'll see SmartCrowd fee, and there's a VAT associated with that. All the other costs that we demonstrate in terms of brokerage fee and so forth, they all have VAT, so that's all included in there. We provide that information on the platform. If you have not done so, register. It's absolutely free. Get a feel for it, and the information that we provide a lot of information. Sometimes maybe a little too much. That's one of the feedbacks we get. But for us, transparency is very important. And these kind of sessions are very important because it's not just about giving us the opportunity. We also want to educate and make people better investors as well too.
I was waiting on this question, Siddiq. We always get this. There's always one person who asks this question. What happens to our investment in the scenario of SmartCrowd going bankrupt?
You'll lose it all. You'll never see me ever again. No, just kidding.
No.
Of course not. This is recorded. Crap, I shouldn't have said that.
This is recorded, yes.
No, so the beauty of our structuring is that your investments, so you have zero exposure of the platform. We have zero interest in your investments that you have made. We are just a platform that enable you to invest in these properties. Each transaction is completely ring fenced, set up in a separate vehicle, a separate company, an SPV in the DIFC. So in the case that if SmartCrowd is no longer around, all the investors are notified and given options. The first option is to move the administration of that company, that SPV, to another administrator that is also regulated by the DIFC, the DFSA rather, or in worst case scenario, to appoint directors from the existing investors to take control and charge of the SPV vehicle. All these are designed, we were regulated, we have to have these plans in place in case something were to happen to SmartCrowd, if you were no longer a going concern. Those places are in there to protect your investment. And we're quite proud of how we structured these things to provide you peace of mind so you can sleep well at night and not worry about your investments.
Thank you so much for that, Siddiq. So I think that's a great time to wrap this up, wrap proceedings this time. And of course, as Siddiq mentioned, next time we'll be looking at some other payment options for our webinar. So when we do send out the invites and the announcements, please make sure to register for the next webinar so you can learn about different ways to invest in real estate, and then of course compare those options with different scenarios in the market, and of course SmartCrowd as well. If you have not registered for SmartCrowd, I would urge you to do so at the earliest. Registering will not cost you a thing. It is absolutely free. Once you do register for the platform, you will have access to market level data reports and all the information at your fingertips, like the pro forma models like Siddiq was going through today. You will have access to everything like that at no charge, because it's completely free to register and sign up to the platform. So on that note, thank you very much for attending. We wish everyone a great evening and a great rest of the night once they break their fast for iftar. So thank you so much, Siddiq.
Thank you, guys. Thanks to everyone for attending.
Thank you. Bye-bye.